So as always, when we shift over to the refined product side, we like to look at the averages that are typically out there. So the current week came in at 14.6 million barrels a day versus last week of 15.098. And again, it's not something that is crazy. You can see that on the average creeped up, but you can see that there's normally that dip that we get when you're looking at the average overall, especially when you're looking at 2018, when you're looking at 2017, when you're looking at 2021. So there's the dip here on the average is very normal. The question is going to be how much closer to that 15.5, 16 million do we get to? And one of the things that we've been talking about is as diesel has weakened, given the increase in inventories, that slowdown in trucking, and how gasoline has really flatlined at what we think to be about 9 to 9.1 million. That's where you're going to see some of those headwinds going into the summer months, because if you remember back in 2021, gasoline stayed below normal, but diesel was just running like a fire. I mean, it was just insane. And now pricing has shifted much higher for both products, which we think is going to, again, limit the amount of activity that we get, which is going to keep us, I think, a bit lower than what we were in 2021. The question is going to be how much lower is going to be, I think, the bigger period in terms of what some of that pressure will be. Now, when we shift over to some of the activity levels, here you can see distillate increased by 2.59 million. That's still 31.9 million below the 5-year average. Pad 1 was where we had the biggest increase. So Pad 1 had a build of 4.5 million. That's still 20 million below the 5-year, with Pad 3 having a drop of 3.04 million. Now, the drop in Pad 3, the increase in Pad 1, we should continue to see that pivot from the Gulf of Mexico into the East Coast, whether it's by Colonial or Jones Act vessels. We do expect to see that increasing shift as Pad 1 does attract the most activity as product comes into not only Atlantic Basin, but also, again, pivots from the Gulf of Mexico into the East Coast. So imports decreased by 42,000 barrels a day. That's still 3 above the 5-year average. And again, that's something that will remain a fixture as more product comes into that Atlantic Basin, again, competing as to do they go into the European markets, especially Northwest Europe, or do they go into the East Coast? So here, Pad 1 had a small drop of 53,000 barrels a day. That's something that, again, remains fairly stable. And the more important thing is when you look at that storage piece, when you look at U.S. storage as an aggregate, you can see that we should be getting those increases, but against that 29-year average, which is that dotted line, we're just not seeing the pace that we really need to see to make sure that we're in a comfortable spot come the middle of September, October, when we start to see those drawdowns, because you can see that we normally build from, let's call it, end of April, beginning of May, through till the middle of September until we start getting draws. And we're just not getting what we need to see in order to get some of that comfort. And here's just putting it into perspective. So the rate of change, obviously, in Pad 1 accelerated, but even with the accelerated increase, we're still well below the 29-year average, which is why we need to continue to see this getting this pace of builds in order to even get remotely close to even the lowest end of that level, which is why, again, Pad 1 continues to be an underlying bright spot. Pad 3, again, still fairly normal when you think about it on the holistic side. We do expect to see more going into Pad 1. It's just going to be a matter of timing. So we do expect let's just say things to be fairly stable when you're looking at storage. And the piece is really going to be on the yield. So right now, yield in distillates was about at 31%. We expect that to remain fairly stable when you're thinking about the refining activity, just because they will remain. This will remain a key target, given not only the shortages in the U.S. on the East Coast, but also how strong the international market is. If a refiner on Pad 3 on the Gulf of Mexico has a great option of, okay, I can sell it into the East Coast, or I can sell it in the international market and make a great premium, they're going to continue again to target that component. and based on the slowdown in demand. So as we were saying last week, we don't expect to see a huge drop. It's just we expect it to be either at the 5-year average or just below. So again, this is something that's very stable, and we don't see too much pivot from this perspective given where the demand sits right now. Now, when we look at the trucking market, you can see that it went from 105 to 84, and a lot of that is driven based on the holiday weekend. There was some of that slowdown. We do expect this to remain in this level, but the trucking market continues to slow. And as the trucking market continues to slow, inventories are back up. As inventories remain elevated, companies are going to look at this and say, all right, well, I'm not in any rush. I have inventory now. Target actually announced that they're going to start increasing some discounts just because they have too much inventory. Obviously, for those that have gotten food, it's not in the food department, but it is in that other stuff because people are just looking to cut where they can, and it's obviously showing up in some of the ancillary pieces. But again, that's going to keep a lid. But when you look going back through 2014, it's still very elevated. It's just not what we had in 2021, which is why we're talking about some of that slowdown between gasoline and diesel, especially given the surge in pricing that we've recently had. Now, on the rail traffic side, things slowed down a touch. On the intermodal front, we expect it to remain essentially in this level and actually attract a little bit more activity just because there isn't that same impetus to get things there instantly. That will, again, companies will say, look, I can either bring one cargo at a time on an 18-wheeler, or I can try to bring 6 or 8 on one train load. So again, they're just going to try to opt for something that is a bit more stable. Grains remaining at the high end increased 11.8%. Motor vehicle parts and everything else, again, strong as a lot of, even though sales are slowing, there's still that backlog. So again, there's a lot of reasons why that will remain elevated. Total carloads down 1% versus 2021. Again, still fairly comfortable. And then when you look at the other piece, the intermodal dip, but again, that it's going to remain fairly strong. So we continue to see some of these pieces. But as we saw with UNP, they had a little bit of a profit warning given some of the pressure that they're seeing as well on the labor front, as well as some of the car loads as we go forward, because we have gotten that slowdown. It continues through June. You can see that June is 13% below previous week, June 19th to June 22nd, sorry. And the previous year, it's 17.6% below. So it's still going to remain that pressure. It takes about 4 to 6 weeks, depending on where you're leaving from, to get from the Chinese coast into the U.S. And again, that's as they reopen, you'll see some of that push through. But that's not going to hit until, let's call it, the second week of July. So really July is when we should see some of that bump. So we should, and again, this is kind of confirming what we've been talking about, some of that slowdown coming into the West Coast. Now on the natural gas propane front, you can see that there's a beautiful heat wave coming through, and it's essentially hitting the whole South from coast to coast, going from California over into Virginia and touching and going all the way to essentially North Dakota, Minnesota, with the Pacific Northwest as well as the Northeast remaining either below or at normal. And again, just because of that heat wave, we do expect to see a very elevated burn of natural gas and coal, just because you're going to need that electricity, which is very good for obviously our hydroelectric plants. But that's just the selfishness that we like to talk about, because when you look at the piece, this is going to obviously support natural gas pricing at these levels. Now, when we shift over to gasoline had a small drop of 810,000 barrels. That's 22.9 million below the 5-year average. But when you look at Pad 1 had an increase of 1.84 million. But it was Pad 3 that had the drop of 3.41 million. But when you break it down between the 5-year averages, Pad 1 is still 14.4 million below the 5-year, while Pad 3 is just 2 million below the 5-year. So it's a matter of that balancing act, and it's really Pad 1 that's going to continue to see that those imports, with imports, as we said last week, We expected them to go to about 1.1 million, and imports increased 285,000 barrels a day to get to 1.175. And then, as we said in Pad 1, that was going to be the driver. Pad 1 had an increase of 328,000 barrels a day, going from 749,000 to 1.077 million, which is obviously well above the 5-year average. There's more behind it. It's slowing down a touch coming from Europe. But again, as European driving actually starts to slow a bit and we remain with these elevated builds, that's going to attract more product coming from Europe into the East Coast. And then when you look at the average, it's at the 29-year average, but we do expect that to essentially, as we said, flatline and then start to edge a bit higher. And we don't expect it to really go back up too much. It's just really more of a flatlining aspect. And as we continue to see some of this, and then the comps get easier as we go through the summer driving season, because you can see that there's normally those draws that happen from, let's just call it the first week of June until the last, first or second week of September until you get that flat line. So again, the comps will get a bit easier as we progress throughout the summer. Now, some of the key pieces that we look at, some of the different pieces, Americans' interest in going out and spending has dipped per Google search activity. Travel-related searches have declined on a 5-week rolling basis as fuel costs and increases in airfare cause people to adjust some of their plans. So there's a mixture of things in this chart. There's people that have already planned, so you can see the increase as we get into March, April. So people are like, well, I already booked my tickets, I already booked my vacation, so why am I looking again? And then there's people that look for deals and wait to the last minute, and those are the ones that are more price sensitive. So that it's a mixture of both. There you have people that look, I'm already booked up, I'm good to go. And there's some people. So there's a mixture of both pieces. So again, this just kind of confirms what we're saying, where we're going to get the increase in activity. We're just not going to get that natural second bump, if you will, to that summer driving component. Now, when you look at motor gasoline total inventories, we're right around that 2015 level. We expect it to flatline a bit more and again look more like 2015 than not, as you can kind of see things when you look through the next few months. You can see that the comps get easier, and 2015 fell back into normal as we get into that September-October period. We think it happens a little bit sooner just because we do have a lot of imports and that slowing demand. Not that we're going to get back to where we were in, let's call it 2019, but really kind of splitting the difference between 2015 and 2019, getting us back closer to that normal period, really by the end of August versus what it took in 2015 till the middle of September. Now, when we look at driving activity, things remain fairly stable in China. We do expect that to ease a touch as things normalize, but again, still remaining strong. While we had a sizable dip in both Europe and the Americas, there's a mixture of that given some of the holidays. Remember, China had the Dragon Feast, so there was that little bit of that bump. But then when you look at the world overall, it's now dipped back below 100. Asia Pacific is flatlining. But when you look at the TomTom data, you can see that sizable drop. And the problem that we're seeing now more in the emerging markets, which is, again, that Asia Pacific, is price, as some of the governments are really talking about cutting some of those pieces. They've already reduced taxes, but then the subsidies is obviously going to become the bigger component going forward. Now, when we look at pricing in the U.S., we now have diesel at $5.72. Again, that's broken to a new all-time high, where when you look at gasoline, it's just gone parabolic and is now at $4.96. And there's a lot of talk that it could be really above $5 as we go into next week. So again, these things are going to weigh significantly on what are the costs not only in the store, but also what is going to be the cost at the pump as that pressure continues to mount on consumers. Blending components, when you look at blending components, there was a small draw of 840,000 barrels. That brings us 18.3 million below the 5-year average. But when you look at the last 10 years, it's right at the 10-year average. We expect that, again, to flatline and start to edge up and go much closer to where we were in 2019 over the next few weeks. Now looking at the driving demand, here you can see that there's that normal, like that dip that we've had. So we had the two weeks of increases, as we were saying before. Because we didn't get a bigger bump last week, we had said that just means that we're going to have 2 weeks of sizable increases versus just one. Because of the Memorial Day refill, you did get an increase in driving capacity, so that has to be backstopped. That's why as we go forward, you can see that over the last, let's call it pretty much the last 10 years, there's typically that dip and then that nice little increase as we go into either this week or next week, and then it stays up there. We're just saying that instead of coming back down, we'll have a little bit of a decline, and then we're going to really just go flat instead of getting that marked shift up. And if you look at that average, which is the 2012 to 2021, we're right at that 10-year average, and we just don't see it really deviating too far from that piece. You'll get your increases normally, obviously, in July 4th weekend into Labor Day. But in terms of actual normal driving schedules, we don't see a bigger increase. Here you can see that there was that drop in workplace, increase in parks. Obviously, a lot of that was driven by the Memorial Day weekend. So things will get back to normal. But again, that workplace side remains 20% below normal, and we don't see that increasing for the year. Propane had a build of 660,000 barrels. That's still 3.9 million below the 5-year average. And again, it's still just following the pace that we had in 2019, 2018, 2017, and we don't see that deviating because there is an increase in demand, elevated exports. So, but there's also more supply, which again is balancing that out. Days of supply increase that will flatline again. So it's just, this is a bit lumpy, and this is a week lagged. So again, we're going to stay fairly stable. Fuel demand had a drop. You can see that we're back at the lows. We're above where we were in 2021. But again, we're still low for this time of year. The jet fuel increased 670,000 barrels, which is just 1.2 million below the 5-year average. And when we start looking at why, I thought this was a good view of fares versus jet fuel. So fares still remain at near record levels. Air travel has gotten increasingly expensive, and higher energy prices are not helping. The average price of a gallon of jet fuel was $3.91, $3.91, 12% increase from the prior month, and 135% increase from the prior year. So you're getting an idea of, again, those airfares really hitting people, which is why when we look at TSA passengers, as we were saying before, this is normally when you start to see that bump. We had it in 2021, we had it in 2019, and we're just not getting it. And again, the price is going to be the piece where we just expect to see a little bit of an increase, so slightly higher highs, slightly higher lows, but still well off of what is normal in 2019. And the data really kind of confirms that as we go forward. The week ahead is just 0.9% lower week on week. So again, steady as she goes, which just is showing that, there's really not a huge increase in that jet fuel demand. Eating out, again, when you look at open table on the weekdays, anywhere between 0% to 5% better, weekends 5 to 10% better. We don't see that adjusting at all, just given where some of the shifts are. The U.S. remains fairly low. If you look at where we are, it's actually dropped, where on average on the weekends we're about 0 to 3% better. Weekdays we're about 5 to 10% worse. And again, a lot of that is to do with price, and some of that is showing up in terms of that slowdown in spending, which obviously we'll talk more on as we go into the Econ show. So that's what we have for you in the U.S. In the next segment, we're going to go broader and look at how some of the things are shifting with differentials on crude, as well as what is happening in the global refined product market.